Good morning, Wall Street. Are you ready for the stock market to rally? In this video, we're going to explore the prospects for just such an event. We're going to look at a couple of stock market indices. We're starting off with the Dow Jones Industrials. And what we're looking at are three indicators that we like to follow. The first is the choppiness indicator. And the choppiness indicator makes it easier for us to determine whether we're in a period of trending versus a period of choppiness. So the higher the choppiness indicator, the more the market has started to chop back and forth. And when the choppiness indicator moves down, that means you have less choppiness and more trendiness. What's important to note is when the choppiness indicator is in decline, what is price doing? As we've identified the trends here, are they uptrends or downtrends? And obviously, in all of these cases, they've been downtrends. And currently, we look like we've just completed another downtrend. And we say completed because this looks kind of like it's starting to turn up. So the fact that the choppiness indicator is turning up is at least suggestive that this decline phase is mature. Now let's look at our EBB indicator as well. This is our Erlanger Big Barf indicator. And what this does is it measures the momentum of the VIX, the CBOE Volatility Index, relative to the momentum of the S&P 100 index. And what we're trying to determine here is how enthusiastic are the options traders relative to the momentum of the market that they're following. The, quote, biggest barf, end quote, occurred here back in October of 2008. And so here the EBB got to minus 60. More importantly, we can see that this occurred at this low. We have the market here at a lower low, and of course we've drifted down to yet a lower low in the market itself. But we have a higher low in the EBB, which means that the enthusiasm, the extreme pessimism in the VIX trading is not so extreme. In fact, we have a higher low here. So what we have is a positive divergence on a daily basis. Right now, I'd say that's a mild positive. And I say that because even though this is a positive divergence, we had a negative divergence here that was a problem. And of course, this market, the long-term trend being what it is going to be more responsive to negative divergences than positive divergences. At least that's the current long-term picture that we're working under. One of the signs that long-term picture might be improving is if we get a more positive response to positive divergences than negative divergences. And that's something that we're just going to have to wait and see later on this year. Now, something else that we've talked about in the past is the seasonality for the market. For the Dow, the low in the seasonal cycle occurred here. And unfortunately, that didn't put in a low for the market there. We've talked about in previous videos how when a market has a seasonally strong period and kind of lays an egg during a seasonally strong period, the next weak period could be severe. And of course, this was the worst January on record here for the stock market. So now, what do we have to look forward to here? One thing that I would note, even though the cycle low for seasonality was here, you see this red coloring here? What that tells us is that from a consistency standpoint, in past seasonal cycles in previous years, this has still been a relatively weak period. And in fact, the seasonal cycle itself just kind of dribbles along here during the first quarter of the year. But heading into the second quarter of the year, you can see that there's hardly any red, typically not been a negative period for the stock market, at least over the last 12 years. And we can see that the green seasonal heat here starts to brighten, which tells us that this is a seasonal sweet spot for the stock market. Now, seasonality does not cause a market to move. It simply reflects tendencies. So if we are going to have a rally, this would be a logical period for the stock market to have a rally, at least from a seasonal standpoint. Now, if you want to fine-tune this a little bit, looking at this little dip right here, which is just before we start to see an acceleration in the seasonal cycle, let's just pinpoint that date here. And that looks to be right around the 16th, 13th to 16th. So the Ides of March seem to be a good launch point for a rally period from a seasonal standpoint. Now, this is the Dow that we're looking at. Let's look at the S&P 100 index. Interesting. This tells us a slightly different story from a seasonal standpoint. I'm just going to go back to the Dow for a second to note the stats on the seasonal cycle. You see this cycle R statistic. That's a 0.34. Now, that's a positive number. And what that does is it tells us how valid the seasonal cycle is. The validity is a correlation between two halves of the historical data in terms of the seasonal cycle. How much of the seasonal pattern exists in the first half of the data as well as the second half. And the higher the correlation, the more valid is the seasonal cycle. In other words, we're seeing a true pattern of seasonality throughout the entire history of the data, attested on two independent portions of the data. If the cycle R was 1, that would be a perfect correlation, which would mean that a seasonal cycle made out of the first 6 years of data was identical to a seasonal cycle made out of the second half of the data. Now, the 2009 R statistic measures the correlation of the current market to its seasonal cycle. And we see, again, a fairly positive number, 0.33, which is telling us that the market has moved with the seasonal cycle so far. So that's for the Dow. Let's go back to the S&P 100 index, the OEX, and let's look at the seasonality data for it. And we see that the cycle R is even better than the Dow's. It's 0.55. That's a very valid number for a seasonal pattern. Now, we're only looking back 9 years, so we're taking a slightly more localized picture of the seasonal cycle. But that's a fairly substantial period. So we've got a seasonal pattern that's worked well over the last 9 years. And I'd also point out to you that the 2009 R statistic is 0.85, which means for all of this year, the seasonal cycle has been down. And the January and February period is the worst 2 months out of the gate for the stock market for the history of the Dow Jones Industrials Average, which goes back to 1896 or thereabouts. So the real question here, and this is kind of a suspense story, is with the turn up in the seasonal pattern, will the market follow that or not? As we said before, last year's upturn in the seasonal cycle was fairly ignored by the markets. So now the question is the market going to rally now? Let's put a time frame on this to see where this low is, right here. And look, it's March 16th, the Ides of March again. So the bottom line is, if there is going to be a rally of significance this year, it would seem from a technical standpoint that the second quarter of this year would be the best time from a seasonal and setup standpoint. Hope that helps. See you next time.